Cracking the stock market code, analyzing stocks for profits. Hello, fellow investors, and welcome back to Raveling Money. And today we're diving deep into the world of stocks. Our mission? To crack the stock market code and help you analyze stocks for profits like a pro. Before we embark on this exciting journey of stock analysis, let's start with the basics. What is the stock market? What is a stock? Stocks represent ownership in a corporation, and owning them means you have a claim on the company's assets and earnings. This includes a share of the company's profits, voting rights in some cases, and the potential for capital appreciation. Stock market function. The stock market is like a giant marketplace where these stocks are bought and sold. It's where companies raise capital, and investors like you and me have the opportunity to participate in their growth. Types of stocks. There are various types of stocks, including common stocks, preferred stocks, and even penny stocks. Understanding the differences is crucial for your investment strategy. Common stocks are the most common type of stock and give you ownership in the company with voting rights. Preferred stocks come with priority dividend payments, but often without voting rights. Penny stocks are low-priced stocks, typically associated with smaller companies and higher volatility. Market participants. The stock market is a complex ecosystem with various participants like retail investors, institutional investors, and market makers. Knowing who's involved can help you navigate it better. Market participants include individual investors like you and me, institutional investors like mutual funds and pension funds, as well as market makers who facilitate trading by buying and selling stocks. Understanding these players can help you grasp market dynamics. Why stock analysis matters. Now that we know what the stock market is, why should we bother with stock analysis? Maximizing returns. Stock analysis helps you make informed decisions to maximize your returns. It's like having a roadmap in the world of investing. Stock analysis involves evaluating various factors to identify stocks with the potential for growth or income. By conducting analysis, you can make investment choices that aim to generate the highest possible returns. Risk management. By analyzing stocks, you can assess the risks associated with each investment and make choices that align with your risk tolerance. Risk management is a crucial aspect of investing. Stock analysis allows you to evaluate the risk-reward trade-off for each investment, helping you avoid overly risky positions and maintain a balanced portfolio. Long-term versus short-term. Stock analysis can also guide your choice between long-term investing for wealth accumulation and short-term trading for quick gains. Stock analysis can inform your investment horizon. Long-term investors focus on fundamentals and aim to hold stocks for extended periods, while short-term traders use technical analysis to capitalize on short-lived price movements. Psychology of investing. Understanding the psychology of investing is crucial. Stock analysis helps you make rational decisions rather than emotional ones. Emotional decisions can lead to impulsive actions that harm your investment performance. Stock analysis provides a systematic framework, reducing the influence of emotions in your decision-making process. Fundamental analysis. Let's jump into the first method of stock analysis, fundamental analysis. Earnings and revenue. Look at a company's earnings and revenue. Are they growing over time? This indicates a healthy and potentially profitable business. Examining a company's income statement reveals its profitability and revenue trends. Consistent growth in earnings and revenue suggests a company is managing its operations well. P/E ratio. The price-to-earnings ratio, P/E, helps you gauge if a stock is overvalued or undervalued. A lower P/E ratio suggests it might be a bargain. The P/E ratio measures how much investors are willing to pay for each dollar of earnings. A lower P/E ratio may indicate that a stock is undervalued compared to its earnings potential. Dividend history. Check the company's dividend history. Consistent dividend payments often indicate financial stability. A history of regular dividend payments demonstrates that a company has a stable financial position and is capable of generating cash flow to reward shareholders. Debt levels. Assess the company's debt levels. High debt can be a red flag, as it may affect the company's ability to grow and pay dividends. High levels of debt can increase a company's financial risk. Fundamental analysis involves evaluating a company's debt-to-equity ratio and its ability to manage debt. Competitive position. Compare the company's competitive position within its industry. A strong competitive advantage can lead to sustained profitability. Assess a company's competitive advantages, such as brand recognition, proprietary technology, or a unique market position. These factors can contribute to long-term success and profitability. Management team. Evaluate the management team's track record and qualifications. Strong leadership can drive a company's success. The competence and integrity of a company's management team are critical. Investigate their past performance and their ability to execute the company's strategic vision. Technical analysis. Now let's explore another powerful tool, technical analysis. Support and resistance. Identify support and resistance levels. These indicate price points where a stock is likely to find buying or selling pressure. Support levels are price points where a stock tends to find buying interest, preventing it from falling further. Resistance levels are where selling pressure typically arises. Moving averages. Use moving averages to smooth out price data and spot trends. They help you determine if a stock is in an uptrend or downtrend. Moving averages provide a visual representation of a stock's price trend over a specific period. They help traders identify potential trend reversals or confirm existing trends. Relative Strength Index (RSI). The RSI measures the stock's recent price strength. It can indicate whether a stock is overbought or oversold. RSI values range from 0 to 100 and are used to assess a stock's momentum. Values above 70 may suggest overbought conditions, while values below 30 may indicate oversold conditions. Candlestick patterns. Learn to read candlestick patterns to gain insights into investor sentiment and potential price reversals. Candlestick patterns provide visual cues about market sentiment. Patterns like doji, engulfing, and hammer can help predict potential changes in direction. Volume analysis. Pay attention to trading volume. A surge in volume can signal significant price movements. Volume measures the number of shares traded in a given period. High volume often accompanies price changes, indicating strong interest from buyers or sellers. Chart patterns. Recognize common chart patterns like head and shoulders, double tops, and flags. These can provide valuable buy or sell signals. Chart patterns form over time and can indicate potential trend reversals or continuations. Traders use these patterns to make decisions based on historical price behavior. Sentiment analysis. And now, let's not forget about the third element, sentiment analysis. Social media. Monitor social media and news for sentiment around a stock. Positive sentiment can drive prices higher, while negative sentiment can drag them down. Social media and news can influence investor sentiment. Tracking mentions and discussions about a stock can provide insights into market sentiment. Market trends. Understand market trends and how they affect stock sentiment. Are we in a bull market or a bear market? The overall market trend can impact individual stock performance. A bull market, characterized by rising prices, generally favors stocks, while a bear market, with falling prices, presents challenges. Analyst recommendations. Consider analyst recommendations. These can provide valuable insights into a stock's potential. Analysts assess stocks and issue recommendations based on their research. These recommendations can influence investor sentiment and stock prices. Economic indicators. Keep an eye on economic indicators like GDP, inflation, and employment figures. These can impact overall market sentiment. Economic indicators reflect the health of the broader economy. Positive economic data can boost investor confidence, while negative data can lead to concerns. There you have it, folks. We've taken a deep dive into the world of stock analysis, from fundamental and technical analysis to sentiment analysis. Remember, analyzing stocks is not about predicting the future. It's about making informed decisions based on available information. Cracking the stock market code may take time and practice, but with dedication, you can become a savvy investor. If you found this video helpful, don't forget to like, subscribe, and share it with your fellow investors. As always, thank you for joining me here on Unraveling Money. Until next time, happy investing, and may your stock picks be ever profitable.